Okay, accounting. I'm going to really quick go through this last section here. We've been talking about T accounts, right side of the accounting equation and the left side of the accounting equation, and debits and credits and increase and decrease sides with the T accounts. So I'm going to show one example and then I'm going to go right into walking you through the work together so you can see some examples and then you can work on your own. So if you receive cash from sales, $295. So if you remember, we're going to go ahead and we're going to have the accounting equation, which is always assets equals liabilities plus owner's equity. All right, so when we have a transaction, remember we're going by dates, not numbers. We're going to look at this and we're going to try to decide which two accounts are being used. So if I hit number one, which accounts are being affected? Well, received cash, so there's cash, and from sales, so we've made a sale. So our two accounts are going to be cash and sales. All right, then how is each account classified? All right, we know cash is something we own, and so it's an asset. And then sales is how we earn money, and it's considered an owner's equity. Then the third thing is, how is each classification changed? So how is each account affected? Well, receive cash. So that tells me that we've received cash, means that we're earning money. So I know that the normal debit side for cash is the left-hand side. It's a debit, I just said that. And so we're increasing cash. So it's going to go on this left-hand side. We're also making a sale. And so we now have more money in our business. And that's how we make money, is through sales. And that's owner's equity. And we increase the owner's equity side with a credit because it's on the right-hand side of the accounting equation. So that's the increase side. Okay? And then the amounts. So it's 295. Now remember a couple of the rules. Whatever we do to this side, we have to do to this side. So we increased cash, so we're going to increase sales. The other rule, remember, is you should have one debit and one credit. And the other rule is there's always going to be only two accounts for each transaction. Only two accounts right now for each transaction. All right, so let's just go ahead and walk through some of these. So I'm going to go here and let's kind of walk through what this is going to look like with the T accounts. All right, so again, on April 10th, it says that you received cash from sales for $600. So I just did that one. So I know, and remember on these T accounts, you want to try to put the debit first. So I already did this. We just did this one. And I know that every time that an asset is increased, that's always a debit. So we always want to put the debit first. So I'm going to put cash. And I know that we increased cash with a debit. And it was for $600. So I'm going to put $600 over here. Then the other account, it says that you received cash from sales, so I'm going to put sales right there. And if you can't remember, if you can remember what you do with the assets, how you increase and decrease assets, that can help you with your other accounts on what you need to do. So I know that I have a debit right now, so I know I need a credit down here. Plus, you should be learning, hopefully, when I say how do you increase or decrease sales, cash, accounts receivable, accounts payable, you should be able to say debits and credits. All right, so with debit, credit. All right, so we received cash from sales. The next one, sold services on account to Sam Erickson. All right, so I sold services on account to Sam Erickson. So if you remember, that's going to be an accounts receivable because I made a sale, and I know the other one is a sale. I didn't receive any cash, but we always have to show when we make the actual sale. You always have to show that. So that's why we have this accounts receivable account. And it's going to be accounts receivable, then it's going to be S. Erickson. And you never have to guess the accounts. They're always going to be given to you. As a business, it's going to be one of the first things that you determine are what are the accounts that you're going to use. And we'll be talking about that in the next couple chapters. So you'll never have to guess on what accounts. But remember, accounts receivable is just a way for us to keep track of people who owe us money. So we actually haven't received the cash yet. They're going to be paying that to us in the future, but we have to show that we made a sale. And so we're going to use accounts receivable to show, hey, we made a sale to this person, they owe us money. So same way we just did the last one, it's going to be $850, as that's going to be a debit, and I know that I increased sales with a credit. So I have a debit and a credit, okay? Let's look at the 14th. I paid cash for rent. Okay, so I paid cash for rent. So rent is going to be those expenses. And expenses, I can tell you right now, always right now are going to have a debit balance. So whenever you come across an expense, it's always going to have a debit balance. So I'm going to put rent expense. And it said I paid cash, so I'm paying cash. Now, why am I doing it like this? Well, I just said rent expenses right now are always going to have debits. And so I'm going to put the debit first. And we are paying $250. And then cash is going to be $250. So I know up here I increased cash because I was receiving cash, so that was a debit. Down here I'm paying cash, so now it's a credit. Okay, and so I'm still having my rule. Then all right, so now on the 18th, we're going to receive cash from Sam Erickson. So now over here, it's time for him to pay up. We already showed that we made that sale. Now we're actually going to get the money for it. So it says that you received cash. So I'm going to go ahead and put cash, because every time I receive cash, I know that that's going to be a debit. And he's only paying part of it. He's not paying all of it, which is fine. So then I'm going to come down here because it says that I received cash from Sam Erickson. So I know that that's going to be that accounts receivable. And now I'm decreasing this. Okay, so these are both assets. One asset's going to increase and the other's decreasing. And it still allows me to do my rule debit and a credit. So Ericksons are going to they still owe us money, they just owe us less. And now we show that we've actually received the cash right there. And then this one, on the 20th, it says that you paid cash to the owner for personal use. Okay, so paid cash. So paid cash, that tells me I'm losing money. So I'm going to go down here and I'm going to put cash, because I know cash is going to be a credit, because I'm paying cash to the owner for personal use. So I'm taking money out. Now, remember, we introduced this. So Sam Erickson. And anytime the owner takes out money for personal use, it's going to be the drawing account. And just like expenses, the drawing account is always going to be a debit. And basically what the drawing account is it's a way that we can keep track of every time the owner takes out personal use. So right now, and we'll talk more about this, but right now, drawing and expenses are always going to be debits. All right, they're always going to be debits. Okay, so those are the transactions that you're going to have. They just built on 2-2 that you did earlier this week. So I want you to go ahead. You'll do the on your own 2-3, and then you'll do the application, and then we're going to just move on through here, and you're going to start doing some of these problems and putting things together. Now, when you get to the mastery problem, they're going to give you a list of accounts in your book, and you're just going to list each account and you're going to start here and go down. So I guess I could just do this one for you. This one's going to be cash. And rather than doing it like what we are here, making a T account like that, when you get here, you're just going to use cash, and you're going to be using the debit and credit side. I may put in the account names for you right here, I guess. Let me see what. So receive cash from the owner as an investment. So I'm going to just put, I'll fill these in maybe. So again, they'll give you a list of these accounts, but it's Vicky Lands Capital. All right, so what it's going to look like is that you're going to put a date. So the date is receive cash from the owner as an investment on the 1st. So I know that I'm receiving cash. So you're going to put the date. So I'm going to go 1, whoops, and then I'm going to put 2700. All right, and then I'm going to come down here to capital, and I'm increasing capital, and I'm going to do all right. Now my next cash one, if it's a debit, I'll put it right here. If it's a credit, I'll put it here and just work down and just work down. All right. I'll probably fill these in before you get to these so that you know which accounts go where, and then you'll just use whichever one. So we're not doing two. This is cumbersome by having to do a T account for each transaction when we can actually just have a T account for each T account for each account, and then just use them multiple times. All right, so hopefully you can walk yourself through that. All right, so if you've got questions on this stuff, make sure you're asking. And I think we're going to probably have a face-to-face meeting next week to check in and just see how everybody's doing and kind of review some things. So I'll be in touch about that.